In this video, we would like to touch upon different approaches to GDP. So there are three approaches that one can take when one looks at the market value of all final goods and services. That's what the definition of GDP is. In far more details, but the three approaches are value-added approach, income approach, and expenditure approach. So there are these three approaches. One can look at GDP, and of course, all the three approaches will end up getting to the same number because they are just different approaches to the same idea. So, in value-added approach, one looks at what is you ask a question that how much is the value addition done at each stage of production, right? So, for example, when you are producing a car, let's say you produce a car which is having a market value of 30,000, in which there was $18,000 worth of steel which was used, and in that making that steel, there was 8,000 worth of iron ore which was used, right? So, if one is interested to figure out how much is the value addition done at each of these stage of production, then the value addition at the first stage is 8,000. So there was nothing out there, and then the one corporation did mining and extracted iron ore from it, and that was worth 8,000, right? And then this iron ore went into production of a steel which was worth then made 18,000. So the steel corporation or the steel company added another 10,000 in making this car. And then similar idea that the auto company or auto corporation uh, took this steel worth 18,000, right, and used that in producing this car which is now worth $30,000. So how much is the contribution or value addition at this stage of production? How much did the auto company add value to this making that car? Obviously, one can see that it's 12,000. The car company did make a car which was worth $30,000, but the 18,000 was the contribution of the steel corporation, in which 8,000 was the contribution of the iron ore mining corporation. And so, what is the value addition of the auto company or auto corporation? Say Ford company, 12,000, right? So, in a value added approach, you would add the value addition at each stage of production. Right? So, there are three stages of production here in this example: iron ore, steel, and car. And at each stage, in the first stage, 8,000 is added. In the second stage, 10,000 is added. In the third stage, 12,000 is added. And that's how we end up getting 30,000, right? So this is the value added approach. Then in the income approach, one looks at the aggregate income. And so everything, all the income that is earned by factors of production, remember, is land, labor, and capital. And land will give you rent. The reward or the income generated from land is rent. The reward that is generated from providing labor is wages, and the reward generated by providing capital is interest or profit, depending on whether it's borrowed, in which case it will be interest, or it is owned finance, which in case it will be profit, right? And then there are further adjustment to depreciation and sales tax and things like that. But in the income approach, one looks at the aggregate income. In the expenditure approach, as the name suggests, now you can easily imagine, is the aggregate expenditure, right? And when you talk about aggregate expenditure from the expanded circular flow, we segmented the society or economy into four players or four economic agents, and the aggregate spending done by these four players or economic agents is what the GDP based on aggregate expenditure approach. Now, who are these four players? These four players or economic agents, whatever is the term that you want to use, or four components or segments of the society, is first is consumers, which spend C part of their spending, aggregate spending. Then you have the firms. Firms spend I part or investment part, or firms have investment spending. Then you have the government, which spends, excuse me, which spends the G part in the aggregate spending. And then you have the rest of the world spending net exports, or exports minus the imports, right? And so these four players, consumers spend C, businesses spend, firms, same word, same idea, spend I, the government spends G, and rest of the world, with when it interacts with the country, given the net effects, is your net exports, right? And the aggregate expenditure is nothing but C plus I plus G plus NX. Of course, C then can be seen, as far as US is concerned, and there are several other countries which kind of have a similar classification, uh, can be seen as spending done on durable goods, something that endures time, cars, non-durable goods, something that does not endure time, eggs, for example, and services, something that you experience, internet. Investments is done by businesses. Please don't get confused with this word investments. These are not financial investments, but business investments, right? Business investments. So we are talking of more like investments in fixed assets of the corporation. So something like computers or fixtures, or furnitures, and things like that. Something that is used in the business. Those assets which are used in the running of the business for several years, and hence the word investment. It's the word investment is from the perspective of the business person or businesses. Then you have the residential fixed investments, and then inventory changes. This inventory changes will be important when you talk about this being in equilibrium, equal to your GDP, or total amount of production. G is just the government spending on goods and services. So the government of a country would spend certain amount on, say, collecting taxes, or providing police services, and having all those spending done, education, funding infrastructure, making roads, and all of those things. All of those will be a part of government spending. And then net exports is exports, what we export to other countries, the goods and services that we export to other countries, and the things that we get from other countries as imports. So the net effect of the two is your net exports, right? So when you aggregate all these individual spending, we get the GDP based on the expenditure approach. And this expenditure approach will be very important in our demand and aggregate supply. So make sure that we kind of get this idea very clear.